M1 money supply in the US grew by an exponential rate of 126% per annum between August 2019 to August 2021, 5 times higher than the compounded annual M1 growth rate of the previous 10 years and 20 times higher than the average of 40 years before that. M2 for 2020 grew by 25% in a single year. Whether we look at M0, M1 or M2, there is no doubt money supply has grown faster than ever in the last 2 years. This has naturally sparked worries among investors about an inflation hike. In this video, we ask 3 macroeconomic experts for their views on inflation, their evaluation of a crack-up boom prospect, and their advice on how to position investment portfolios amid rising inflation fears. Egon von Greyerz is the founder and managing partner of Matterhorn Asset Management and a leading financial expert in macroeconomic risk and precious metal markets. Ronni Stoeferle is managing partner of Incrementum AG in Liechtenstein, international bestseller author and advisor and board member of multiple reputable financial institutions, including Matterhorn Asset Management. Grant Williams is a senior investment advisor, a portfolio and strategy advisor, co-founder of financial news broadcasting channel Real Vision TV, author and publisher of Things That Make You Go, He too is an advisor to Matterhorn Asset Management. In Egon von Greyerz' view, inflation doesn't come from higher prices, but from the collapse of the underlying currencies. History lessons and his technical and fundamental reading of the current economy all point to an inevitable currency collapse and a future of inflation and hyperinflation.
But if we look back, and we can look back to the Roman Empire in the 2nd and 3rd century, we can look back to the 1720s and John Law in France, or the South Sea bubble in the UK, or any inflationary event in the world or hyperinflationary event. It's nobody wanted to raise interest rates, and inflation, as we know, doesn't come from higher prices. Inflation comes from a collapsing currency, and I think a lot of people are totally forgetting this. Even when Lacey Hunt talks, he said, I don't know if he's still of that opinion, that the Fed only buys assets. They can't actually print money, or because they can only buy existing assets, and therefore he says that you can't create any inflation as long as that happens. But why? I think he's totally disregarded the currency aspect, because I see some of the questions coming up here and say, why isn't the dollar falling? Why isn't the dollar falling? The dollar has fallen 98% since 1971. It's fallen 85% since 2000. That is in real terms measured in gold, which is the only way we look at it. So nobody can say that the dollar isn't falling. It's just not going down in a straight line. But in my view, and I'm looking at it both fundamentally and technically, I think the next fall of the dollar is not far away. I know we have our friend Brent Johnson's milkshake theory that the dollar is going to go up first before it goes down. It's always possible that it goes up a bit, but it's inevitable that the dollar and all the other currencies will fall, and this is what will create the inflation and the hyperinflation, not gradually increase in prices.
Grant Williams reminds investors of the lessons from the Lehman Brothers crisis. History is repeating itself today in the flashing signs from the reverse repo market and growing liquidity contraction in the broader markets, signals that retail investors often miss.
What people need to understand is, away from those headlines about markets at all-time highs, what the professionals see, what the professionals have access to, is information that retail investors don't have. And that information, reverse repos being one of them, suggests that there are warning signs flashing about liquidity. And if liquidity dissipates in this market, then the markets will go lower, make no bones about it. If there isn't ample liquidity, then markets are going to struggle. So you're right. What we're seeing is a sign that liquidity is contracting. There are plenty of other signs that you, as I say, you won't really see unless you really dig into the plumbing, but they're quite consistent across the board. And so that's another signal that it's a time to be cautious. It's a time to understand that the free market, free money, the wild markets crescendoing day after day after day, it doesn't go on forever. And you only have to understand a little bit of history to see that. So I think reverse repo is a flashing warning sign that something's not right with the plumbing of the system. And when something's not right with the plumbing of the system, generally that's a problem for the system overall. Lehman was a plumbing problem, really. That's what took Lehman under.
Ronni Stoeferle urges market watchers to assess inflation prospects by looking beyond CPI and at inflation-sensitive asset classes such as precious metals and agricultural commodities. He forecasts a crack-up boom in full bloom, with central banks now backed by governments to have unlimited credit supply power. In a crack-up boom scenario, money and credit supply keeps expanding at an accelerated rate. This puts a strain on a country's fiscal capacity, leading to unsustainable and rapid price increases or inflation. The loop keeps playing, and the consequence would be a final and total catastrophic crash of the currency system involved. Listen to Ronni Stoeferle's analysis here.
We're currently writing a special report about inflation. And most people that we talk about, not monetary inflation or asset price inflation, but real price inflation that you measure with, those PCE and CPI baskets. And we could discuss them at length. But most people think, there's no way that we will really see a consumer price inflation coming up. And I just tell those people, first of all, everybody is saying that. Secondly, have a look at the tips market, have a look at precious metals, have a look at copper markets, have a look at agricultural commodities. Most inflation-sensitive asset classes are screaming inflation. So from my point of view, inflation might really become one of the bigger topics going forward. And I think Russell Napier made some very interesting observations, basically saying that central banks as well as commercial banks have kind of lost control over money creation. And he says that it's basically gonna be like many other things, going more into the hands of governments. They gave some credit guarantees over the last couple of months, and he sees that this might really become the big trend going forward. So the government is basically guaranteeing you 200 billion for, I don't know, a new Green Deal, education deal, infrastructure deal, whatever. And of course, the bank is going to say, well, if the government backs it, of course, I'm going to do the loan. So I think this is a very interesting thought. And additionally to this inflation driver, I think also the direction into ESG might turn out to be inflationary. And the second thing is, if you follow geopolitics, it seems like a proper Cold War is getting started between China and the US. And from my point of view, that should also be very, very much inflationary.
How can we protect ourselves against a looming inflation and an impending crack-up boom? We ask Grant Williams. Turns out timing and risk appetite are crucial. At the end of the game, the winners are going to be those who are prepared with the right portfolio mindset, holding real assets, not financial assets, and focusing on value, not growth.
But what all those conversations have really hammered home to me is it's about timing. Because you're right, Egon, I think we get both. And do we get one last deflationary shock? It's highly possible that we do. So it really comes down to an individual investor and what are you trying to manage? What's the time horizon you're trying to manage here? Because if you have, I think, anything past a couple of years is the time horizon you're looking to invest along, then I think you have to be concerned about inflation. Because if we do get that deflationary shock, we've already seen what they're going to do. They will go to lengths that will make what they've done so far seem, trivial. So we can expect a monetary blitz, we can expect a fiscal blitz, we can expect them to cap yield curves, we can expect them to do all kinds of things. They will do anything at this point to stop that deflationary pulse taking hold. So while you may get a deflationary outcome in the short term, I personally have come down on the side that long-term inflation is the thing I have to be most concerned about. And I've talked about this before in other conversations, but the big thing for investors is to understand that if you've had a portfolio that has been set up to benefit from a deflationary tailwind, that portfolio has performed very well for 40 years. It will perform terribly if we have an inflationary environment for obvious reasons. And so this inflection point that we seem to be at or close to suggests that if we do shift from deflation to inflation, then that 180-degree shift does the same in all kinds of areas. It changes the focus on away from financial assets and towards real assets. It changes the focus from, it ends that duration bull market, as Dylan has talked about. It means you want to be in value, not growth. It means you want to have active managers, not passive managers. And it means that your portfolio is potentially set up the exact opposite to how it needs to be set up to manage the conditions going forward. So I think everybody has to take part in this debate and at least listen to both sides, think it through for yourself, understand what does it mean for my portfolio if the inflationists are right, and then decide if you think they're right. If you think they're right, then you have work to do in your portfolio. If you think they're right but not yet, then you probably don't have work to do, but you need to start creating a plan for that point in time where you think, okay, now's the time the inflationists are going to be right. And if you think that Lacey and David and the deflationists continue to be right, and they will be right for the foreseeable future, then frankly, you can sit back with your portfolio and you'll probably still do okay. But everybody has to do those calculations now. It's incumbent, I think, on everybody who's investing to take this seriously, because if this inflection point is real, it does change everything.
For more expert views on macroeconomic risks, wealth management, and precious metal investment solutions, check out our other videos and click below to subscribe to our channel. Gold Switzerland with Egon von Greyerz.